I just made over 200% trading some options today, so I'm having an amazing day. And all I want to do is teach you guys how to do the exact same thing. But before I can do that, you guys have to open your accounts first and get the platforms going, and that way you guys can actually start trading some stocks. But if you guys want to know what I made that money on, it was called Sensionomics Holdings. So let me show you here quickly. So today the stock went up about 80%. In the 5-day chart, it was around 93 cents. So if you bought it at the 90-cent mark and sold it today, you would have made 220%. But luckily this stock was on the New York Stock Exchange, so it's open for a lot of the other platforms. But the reason why I want to show you guys this is because a lot of these penny stocks and high risk stocks, you're not able to get on all the different platforms. So it's really important on which platform you choose. But if you did choose the wrong one, it's okay. You guys can just open up another account because you guys can have unlimited accounts. So without wasting any more time, let's get right into it. What's going on, boys and girls? If you're new to the channel, my name is Gagan Grewal, and if you're already a subscriber, thank you very much, and I really appreciate that. And last but not least, I'm not a financial advisor. Everything I say and do in my videos is my opinion only, and it's not to be taken as investment advice. So I'm going to start off by showing you guys all the different account options, really the main ones that people use to trade, and as well as some of the things that you guys need to consider before putting money into those accounts. After that, I'll show you guys the platforms that you guys can use to actually begin trading. So let's get right into it. So there's two main categories of accounts: registered and non-registered. The registered accounts give you some sort of tax benefits, whereas the non-registered accounts don't. So out of the registered accounts, the main ones are the tax-free savings account and the RRSP. The tax-free savings account, which is the TFSA, this is money that you'll be contributing, which is already after tax. So the money that you've received, you've already paid tax on it. So if you decide to invest this money, any gains that you make on this money, you don't have to pay additional tax on. Whereas with the RRSP, it's a little bit different. With this account, if you decide to invest $1,000, that $1,000 will actually reduce your net income. So you'll get that tax that you paid originally, you'll get that tax back. So because you're not paying tax on this investment, when you decide to take that money out of the account, that's when you'll be taxed. So this kind of depends on like what your tax bracket is now and what you think it will be in the future. But I'll discuss that a little bit more later on in the video. The non-registered accounts, the cash account, doesn't have any special benefit. Whatever money you put in there, it's already after tax, but if you make money on it, you'll have to pay tax on that. The margin account is a little bit different. So with the margin account, it increases your borrowing power. So if you prefer a high risk, high reward kind of thing, this account would be a little bit better, but there are a few drawbacks. So with this account, the bank uses the securities in your account as a collateral. By securities, I mean like the stocks that you guys are purchasing. So essentially borrowing money to purchase a stock. So if you can't pay that borrowed money back, they'll just take that stock away from you. So that's where the pitfall is for that account. So the American account types are actually very similar to the Canadian account types, other than the 401k and the 403b, which these are the employer sponsored plans, so we can't actually open them as individuals. But the ones that we can open are the registered accounts, which are the traditional IRA or the individual retirement account or the Roth IRA. And these are the exact same as our TFSA and RRSP accounts as well. The traditional IRA is like our RRSP account. So with this account, the amount that you deposit is tax deductible and everything that you gain is tax deferred. So you only pay taxes once you withdraw the money. Whereas with the Roth IRA, it's the same as our TFSA, so this is after-tax money. So since it's after-tax money, when you withdraw the funds, you don't have to pay any taxes on it. So it's essentially the same thing, but some of the limits are different, so you might want to make sure that you aren't over-contributing, because you will have to pay a 1% penalty per month. So that adds up very quickly, so please make sure you guys aren't over-contributing. So diving a little bit deeper into the TFSA, so it was originally started in 2009, and you have to be the age of 18, have a social insurance number, and be a Canadian resident to open up a TFSA account. And of course, if you're an American resident, you're not able to open this account. You would have to open up your Roth or traditional IRA account and be an American citizen. So how this account works is that each year the government gives you a limit. So if we look at the 2015 limit, it was 10,000. the 2016 limit was 5,500. So if you turned 18 in 2015, your limit was 10,000. If you didn't invest anything into that account, in 2016 your limit would now be 15,500. And again, if you didn't invest anything, in 2017 your limit would then be 21,000. So this just increases your limit each year. But if you do invest, say for example in 2015 you've invested the entire 10,000, in 2016 you can only invest an additional 5,500. So it's a running total. As you invest that, your limit goes lower, and if you draw money out, you're not able to put it right back in. So be careful. Don't be opening up 10 different accounts, throwing all your money in there, and then pulling it out and realizing, oh, I want to switch an account, I want a different platform, and then you open up a different platform and throw all your money in there again, because you will be over contributing. So if you open up one platform, you put $10,000 in there and take it out, your limit is still zero because you've already contributed that $10,000 in once, and the limit resets every January. So be careful. If you are trying to swap platforms, do this during the December time because the limits of course reset in January. And this account is designed to be easily accessed before retirement if you guys need the funds to buy like a car, a house, or anything like that, because the funds are already taxed. So everything that's in the account is yours, and you guys don't have to think about what tax you'll have to pay next year or anything like that. So there aren't any other consequences to it. And if you guys don't know what your contribution limit is, you guys can go on the CRA website and I'll tell you how much room you guys have left. And other than that, we have it a lot better than the people in the States, because for us, we have a separate limit for the TFSA and the RRSP, whereas for Americans, you guys have a combined limit for both accounts. And in addition to that, 2015 was an exception for us because the American limit was still 5,500. So these limits apply for both our account and the Roth and traditional IRA accounts. So from 2016 to 2021, all the limits are the exact same. And if you guys want to know what the limits are before 2015, you guys can go to Google and just type in TFSA limits and it'll show up right away. So now looking into the RRSP account, the contribution limit is a little bit different for this account. It's the lesser of the two. So either 18% of your earned income in the previous year, or 27,230 for 2020, or 27,830 for 2021. The second point you guys don't have to worry about unless your income is above 150,000, because if it is below, then most likely you'll have to just take 18% of your earned income. So with this account, it does let you defer the tax until you want to withdraw the amounts, but there is one exception. If you are a first-time home buyer, there's a plan that lets you withdraw $35,000 out of this account if you're purchasing your first home. But the exception is that you guys have to pay that money back within 15 years, and if you guys don't, you'll be taxed on that money that you pulled out. So the main reason someone would want to open up an RRSP account instead of their tax-free savings account is really just to defer their income. So I'll give you guys an example. If you're making $98,000, you'd be paying 26% from the federal side, but also you'd be paying 12.29% in the BC tax. So that's a total of 38.29%. But if you make a deposit of $5,000 into your RRSP account, your income is then reduced to $93,000. At $93,000, this means that you'll be paying 20.5% in federal tax and also 10.5% in BC tax. So that's a total of 31%. So that savings is 7%. And you guys may think that it's not a lot, but it adds up very quick. And let's consider that when you do retire and when you are planning to withdraw these funds, let's say you're only making $45,000. If you're only making $45,000, you're only paying 22% tax on that compared to like 38% that you'd be paying now. So there is a large amount of savings that you guys can do if you guys just plan ahead and know what your goals are and when you plan on taking the money out. So now we can actually start looking at which platforms you guys may want to use, but paying the fees for buying the stocks is a very big thing, and this is a very quick example that I want to walk you guys through. So if you have $1,000 and you open up a TD direct investing account which charges $10 per trade, you'd be paying $10 to buy the stock, $10 to sell the stock. So you would need to have your stock increase by over 2% to break even. Whereas if you guys have $100, you'd be paying $10 to buy the stock, $10 to sell the stock. So you would need the stock to increase by 20%. So depending on how much money you guys have to invest, that's when the fees really matter. So we'll start off with Wealthsimple, and I would recommend this for any investor that is brand new to investing and they don't have a lot of money to invest in the first place. Because with Wealthsimple, there aren't any fees, so you can buy stocks for free, you can sell them for free, and you can buy and sell ETFs as well. In addition to that, there's no minimum for this account, because for some accounts you would have to deposit $1,000 to even open the account. So since there's no minimum for this account, it would be perfect for like the investor that really wants to just test the market and see how it is. Some of the drawbacks are that there's no mobile site for this. It's all through your phone, and the website, it doesn't tell you a lot of financial data about the company, but that's not really hard to do because it's all accessible through Google or other websites as well. Another really good thing about this website is that it has a robo-advisor. A robo-advisor uses an algorithm to automate your investing process. So what you have to do is just answer a few questions about yourself, what your risk is, what type of industries that you guys like, and through that, like a computer uses the algorithm and puts your money into ETFs. So if you guys don't remember what an ETF is, just remember it's like a basket of assets. So it diversifies your risk. So the chances of you losing money are slim, or definitely less than buying a single stock. And you guys don't have to do anything because it does everything for you. However, some of the other drawbacks to this website is that you aren't able to open any margin accounts, or you're not able to trade any like options. It's only the TFSA, RRSP, and the cash account. And in addition, you're also not able to trade any over-the-counter stocks or stocks that aren't actually listed on the big formal exchanges. So what this is that some of the smaller companies that don't actually meet the requirements to get listed on the New York Stock Exchange or the NASDAQ, they will be listed on over-the-counter exchanges. So a lot of like the riskier, like the penny stocks, or the companies that don't want to be paying those big fees to be listed on those exchanges, you won't be able to trade with Wealthsimple. So with Wealthsimple, it's really just the big popular companies. So I would definitely recommend this platform if you do want to trade for free, get the hang of buying and selling, and just try to work on learning to invest, and then you can transfer over to other accounts. So the next one is Questrade, and this platform is actually really good. The minimum fee is $5 to a maximum of $10. In addition to that, there's no annual fees, there's no fees on any ETFs, there's really good customer service, it has a good website, has a good app. The only drawback is that you need a minimum of $1,000 to start trading and actually open the account. So if you have over $1,000, I would recommend this as your first choice, because it also has quite a few account options. So there's TFSA, RRSP, and the margin accounts, which the Wealthsimple account didn't have. So it's a pretty good starting platform. So the last account for us Canadians that I would recommend is the TD account. And personally, this is my favorite. This is the one that I use. And the reason why I like to use this account is because with this account, I can transfer from my checking account into my investment accounts right away in real time. Whereas with all the other platforms, you have to wait 5 business days for that money to actually be transferred. And like you guys saw in the stock I showed you right in the beginning of the video, that went up 220% in 5 days. So a lot can happen in 5 days, but if you guys aren't in any rush and you guys don't want to be like day traders, you guys want to be actual investors for the long run, 5 days is not a big deal. But I just really like TD because I like having everything in one place. The only drawback is that with TD, there is a $10 fee per trade. So if you're buying, it's $10. If you're selling, it's $10. And for options, it's $1.25 per contract. So it is a little bit more expensive, but you do get a lot more advantages with TD. So there's a lot more financial data that you guys can see, a lot of news articles that you guys can read on the platform, also see what other analysts are rating it at. Overall, I haven't had any problems with it. And actually, I've had really good experience with it so far. And in addition to that, there's also a $1,100 bonus that you guys can get if you guys sign up. The condition is that you guys have to have $15,000 in the account for I think a minimum of 2 months. But if you're investing anyways, it's a free $1,100. That's quite a bit. So I would definitely check that out if you guys have the funds for that. So for the US investors, I'm going to recommend Robinhood. This is actually a very good platform with no fees, no account minimum either, and you're able to trade cryptocurrencies. And I forgot to mention, Wealthsimple, you're also able to trade cryptocurrencies. You're not able to trade cryptocurrencies with Questrade or TD. So definitely check out Wealthsimple if you're interested in that. A really big thing of Robinhood is you're actually able to buy fractional shares. That is huge. So when a Tesla share is like $1,000 almost and you don't have $1,000 to invest, you can put any amount of money into it. And that's really, really good for these new investors that are coming into the market, because now you're actually able to diversify a lot easier. And usually diversifying is very hard because you need a lot of money to put in all the different sectors because the stock prices are so high. But that's not really a problem with fractional shares anymore, because if you have $1,000, you can evenly divide up however much money you want, and the entire money will go towards actually buying that share. But some of the drawbacks to this platform is that you're only able to open taxable accounts. So you're not able to open like the Roth or the traditional IRA accounts. In addition, it does have a limited product range, and there's not a lot of customer support on this. And last but not least, we have Webull. This one's really good as well because there's no commissions, no minimum deposits. You guys can trade stocks, options, ETFs. You guys can open all the different account types. In addition, this actually has full extended hour trading, which not a lot of other platforms have. So in Canada, the stock market's open from 6:30 a.m. to 1 p.m. But with after market and before market hour trading, we can actually trade at like 1 a.m. all the way up until 5 p.m. So unfortunately, Webull isn't available to us, but for anyone that is living in the States, definitely check this out because it's worth it. In addition, it does have a lot of analysis tools to help you guys out, and the desktop version is pretty good. So I'll just show you guys how it kind of looks and what kind of information it shows you. So something like Wealthsimple doesn't really show you a lot of information on that site. Whereas with Webull, it kind of gives you like the market cap, it gives you what the company does on the sides here. It gives you all the news, financials, releases, gives you kind of the hot stocks. So it is definitely something to worth check out. But unfortunately, like I said again, for us Canadians, we're not able to use this. So I would recommend Wealthsimple if you guys are new to investing and you want to save out on the fees. Questrade or TD if you guys want all your money kind of in one account. And last but not least, if you guys like this video and you feel like I've helped you out in some way, please give it a thumbs up and hit the subscribe button down below. If you guys want me to make any videos on anything else, or if you guys didn't understand anything, please leave it in the comments down below and I'll definitely either try making a video or getting back to you guys and helping you guys out. Until then, see you next time.